A little bit. Like I heard
The clink?
nothing. I don't know what it was. Or who it was. Or maybe it was over.
Any clinks?
And you're all wondering, what is he waiting for? It's not 11:30 yet. That's what I'm waiting for. This morning I did manage to write 2,000 words in addition to everything else. It's like I said earlier, you make your own luck. I've got a book due to the editor tomorrow. My target was 50,000 words. I'm at 56,000 words with no end in sight. So yeah, no shit, I got 2,000 words. I should be writing on this break, but Michael will bend my ear on something. It'll be cool. We'll write later, like all night, so I can get the book to the editor. I probably won't even get the full thing to her. I'll send what I have and say, oh, by the way, I'll send the next chapter, the last chapter, before you finish editing. And then she'll let me have it. Part-time hitman, full-time accountant, coming to you live for you Australians, because your shit is kind of weird when it comes to how the government tries to take a cut of your money. And they don't need to take as big a cut as some of you have paid them. So here's some tips, tricks, and ways to keep your head above water and out of trouble.
Thanks very much, everyone. It's an honour to be invited to speak to all of you, and well done for all coming out to play a part in this on like a normal festive break. And I will do my best to keep you all entertained for the next hour when you are subjected to this sort of material. I'm already grateful. So let's see how today goes as a particular format. I was saying to a lady at my table only earlier that normally when I present on this sort of material, the stuff is so dry that you need to try to find a way to make it accessible because it's relevant to everybody in the room. You've all got the same sort of questions going on in your life when it comes to this sort of tricky stuff. And I know from sort of dealing with just writers and creatives in our business that it's a common thing that you're all driven by creative means more than the numbers and tax. I know that this particular topic is the most boring aspect of your life, but what we try to do in my firm as we deal with clients is trying to make them appreciate that there's actually a story to tell in the numbers that are in front of you. And I know that it sort of baffles many of you in the room and it may not be your strong suit, but what you need to do with all of this stuff is just break it down like any of the other technical aspects of your life and your career, and try to just learn it piece by piece, and over time the puzzle is sort of put together more and more. But one of the things that is sort of really important in that is trying to find an accountant, I guess, that's actually right for you. So in my game in accounting, one of the things that's sort of happening as a bit of a trend is that firms more and more are actually trying to find areas of specialisation. So unless you're one of the really big firms that is big enough to actually specialise in multiple departments, the rest of the sector is actually trying to find an area where they can, I guess, control the risks in their own practice, because it's getting harder and harder as the rules get more complicated to be good at everything. And so for us, we just deal in the creative entertainment space. And we find that is a way of being able to minimise the risks for us, and just making sure that we provide the right advice to you as a client. The thing that you need, I think, mostly in what you do is finding someone who's able to actually understand your industry, because each of these industries everywhere are just getting more and more complex. How do you do that? I mean, honestly, today is one of these sort of forums where you can try to find someone who actually specialises. I can say, being an operator in the creative space, that nationwide in Australia, there's actually not many practitioners that do what my practice, Creative Crunches, does. Even in the Arts Hub of Melbourne, there's still only really a handful of firms who do this. So it's not hard to find us. All you need to do is really get onto Google and start to search for arts accountants, and you'll start to find, the 20 odd firms that exist. And after you have made some inquiries, then hopefully you'll be able to find one of those firms which is sort of right for you. And it doesn't need to be local. A lot of people try to latch onto an accountant that is local because that face-to-face contact is what they need. And if that's the case, then that's what you should do. But in an ever-increasingly electronic space, I can tell you that a lot of the communications we have with our clients, it's not that they need to be local. And even people that live in the same suburb may not necessarily be a face-to-face appointment. It's all Excel spreadsheets, email chains, and phone calls, and that's fine as well. The biggest thing is trying to find an accountant who's going to start talking your language. But I think if you sort of approach that as a first step of just trying to find a firm that specialises in what you do, I think you'll start to find an advisor that helps you to start breaking down the jargon and helping you to make sense of all of this tax and accounting landscape. So what I've done today, Jane was kind enough to provide me with, I guess, a list of issues that were posted to her in terms of like what, as a group, you wanted to find out about, because with all this material, there's almost no end. I mean, you don't want to listen to me for a day, but I could talk to you for a day on everything that you need to know, because really, and I think you'll know this all yourselves, it's a very specific landscape. There's lots of little things that you drill into, and it's at that deeper level of detail that all of your questions arise. So the thing with a format like today, and only an hour, is trying to give you as much information as I can, and then I would sort of encourage you to come and pick my brains in the breaks, and when we finish today, if you've got any more specific burning questions, because I was talking earlier with a lady at my table, and we probably talked for 35 minutes solidly and approached 2 topics that are in these slides, and that's it. How do you actually record what you're doing in your creative life? There's no one way to skin a cat, but I can tell you the basic Excel spreadsheet is your friend. Really, it all boils down to getting into a good habit of being able to be aware of all of the business transactions that are affecting you as a creative, not just at 30th of June, but on every given day of the year. Because the more you start thinking about the income and expense lines and just what you're doing from a business point of view, the more you're doing that each year, and I know that there's probably some part-timers in here, there's probably some full-timers, there is still a lot of time in the year where you're doing what you do, and almost certainly underneath that time is an expense. And so it's about training your mind to be able to pick up all of the loose receipts, electronic invoices, paperwork, and be at least documenting that, and then trying to find a way of how to get all of that source information into something meaningful for the accountant, so that the accountant is not coming back to you saying, what on earth does all of this mean? It's about trying to take all the raw data and put it into something meaningful, not just for you, but for people like us who are trying to help you. And so the reality of all of that process is that Excel templates are basically the first go-to tool for you to master, because beyond that platform, the next step up really is dedicated accounting-based software. Some of you, is there, show of hands, like how many in the room are using Excel-driven templates? All right, and how many of you have gone to the next step where you're using MYOB or Xero? All right, so that's probably more in the accounting program space than I expected to see. That's usually not so high. But as an accountant, what we see is that the usage of the accounting programs is a beast all of itself. And it's like any piece of software. Garbage in is garbage out. And so we're finding at the moment with the rapid pace of technology, and all of you in the room are actually pretty prime candidates for this particular shift where, you know, you've got income coming in from overseas sources, you're starting to get PayPal accounts and electronically driven payment systems, and they're filtering into Australia, and your question is, how do I make sense of all of this? And the accounting programs are a particular piece of software that are primely placed to assist you, but I can tell you as an accountant dealing with clients that are using those platforms that there's still not a foolproof piece of technology. They're continually evolving as well, and it's about how to extract that information or train the software to tell you, I guess, when you're making a mistake. And one of the biggest things that is, a beef of mine is that those software companies don't really market honestly to you in terms of how good they think their software is at just taking all of the complexity out of your life. Just like let the software handle it. It almost makes it sound as though these software platforms are next to AI standard of technology, whereas there is nothing further from the truth at the moment. The reality of those programs in the background is that they're very technical pieces of software. They're very powerful, but they actually need to be used correctly. And you know, where they really need to step up at the moment, in my view, is being better at telling you when you're making a mistake. And so part of, I think, why the advice is for you to latch on to the right advisor is especially for those people that are using those programs, trying to find an accountant who's actually properly versed in that software. Because our role as accountants are rapidly changing from not just being bean counters and having to understand spreadsheets and numbers and tax, but also having to be relative experts in the actual software and helping to design those platforms for the client and helping to mitigate those risks. And it's a learning curve. So the right accountant for you is someone who's going to have those skills and also know how to help train you so that you can get better at using them. All right, so starting out, there's probably a whole bunch of you in the room that are at all these various stages of your career. But for anyone just starting out, the basic tax ruling that I'd point you to is called TR 2005/1. Now, I also understand these slides here today, they're really just designed to give you some headings so that you can listen to me bang on and hopefully have the information sink in. But there's a whole bunch of more detailed slides with some further notes broken down that they can be provided to you or already have been. And these sorts of things that I talk about are in those slides. TR 2005/1 is a particular ruling that the ATO issued that describe their point of view of what a professional arts business is. Now, as I gather that most of them in the room are probably beyond this starting out, I would just point that particular ruling to anyone who's really just starting out in their career. That ruling is probably one of the better rulings for you to read. It's still probably, nighttime reading when you just need to get to sleep, but it is actually full of practical worked examples as to what your regulator expects to see of you if if you're to demonstrate to them or prove to them that you're running a business. But one of the most important things about that ruling that you'll find, and this is still relevant for everyone in the room, it's not about how much you make. It's not about how much you're turning over. It's not about how much profit you're even making. In the creative game, and it isn't just writing, this is all the genres that we see, the lead time that you guys expect to see from the first moment that you go starting out to when you first start to turn a profit, or just break even or whatever it might be. Those are traditionally very long lead times. You need to work harder at it than a lot of other traditional businesses, because the thing that categorizes or separates you from the rest is that you generally are having to create your own market. There is a market out there for what you do, but there is not a market for you as that author or that pen name, and that's what you're trying to develop. And everyone in the creative space has to start from scratch when it comes to that. And there's no magical formula that makes that success, because if there was, we'd all use it. The best part about that ruling is that it codifies that principle. So you need to know in the back of your mind that even if you've got expenses coming out the back end and there isn't the money coming through yet, that doesn't mean that you're not running a business. Many of you in the room would have an ABN. If you've already started venturing out, you would know that the ABN is like the cornerstone. It's like a tax file number for business. And the whole point is that as soon as you've actually got one of those or applied for it, underneath that is there's already a checkbox or a thing that you've signed off on saying that you are meeting all of these characteristics that exist in that particular ruling. So even though everyone starts out at a base of 0, that doesn't mean that you are not yet in business. Being in business is actually more about a mindset of when you are prepared to get serious about what you're doing and then do all of the qualitative things that come with being in business. So, the hobbyist is never going to bother recording all of their income expenses. They're never going to bother being here, or even if they do come here, they're not the sort of people that are going to take all that information home and really use it to get further on in their career. The business-minded person is going to do all these things, and that's the difference. It's got nothing to do with the amount of money, it's got everything to do with what you're doing, how you qualitatively conduct yourself. And in the ruling as well, they sort of talk about this very concept, saying, look, we can break down all of the different characteristics, and ultimately there's an overriding one which says, if we can, no one particular factor is determinative in any case. It's really just, do we have an overall commercial flavour when we look at that particular person's case? But one thing that's interesting is that there are lots of little thresholds in the Tax Act that do throw monetary propositions at you. So one thing that is probably common in the room, has anyone heard of a particular threshold where it's like, if I earn more than $40,000, then things are sort of legitimately in business. If I'm under 40,000, it doesn't matter. So there's one threshold, right? And when we hear people talking about that, they will list that 40,000 threshold in a whole series of different ways, which means it's a misunderstood threshold, but it's a threshold which you're all inherently governed by. And this is what they call non-commercial loss provisions. So look, the non-commercial loss provisions have been around for a while. They came back in around 2001, I think. And what they basically are saying is, if you are running a business and your expenses are outweighing your income, okay, that's almost everyone in the room, unless you've had a massive lucky break really early. And that's not just the first year, that could be several years, that could be 8 years. We've seen script writers on our books that toil for, 11, 13 years before they get a script which changes the game for them. So the lead times are long. What the ATO, in their infinite wisdom, said in 2001 is like, we're leaking revenue from that particular concept. So we're going to come in and say, okay, if we do have a business out there in Australia which is generating these losses, we're going to start trying to make that business jump through a few more hoops before we allow them to deduct that loss against other income sources that they've got. Now, from a government's perspective, it's a piece of legislation that makes sense, but it affects every single business that the country's got. So what happened when those laws came in is that the arts community and farmers in particular said, hold on a second, there must be a carve out from this, because we run businesses and your ruling tells us that you're satisfied that we're running a business, but we've got very different businesses to the standard, okay? The farmers, right now it's very, very present in everyone's mind. What if we've got 5 years of drought? What if we have no crops 5 years in a row? Well, that's no income or very, very little, and expenses just do not stop. And so that's farmers. And then the arts community was also, well, hold on, we're also uniquely placed with this because, you know, we've got these long lead times, and even if we have got our business through a period of years to, you know, generate our first profit, there is absolutely no guarantee year number 2 or year number 6 is going to be the same thing. And a very typical example is where you've got a visual artist that would, you know, maybe spend the best part of their year putting together an exhibition. So they may have a year where there's no income from that business at all and expenses very high. And it's the next year in which they exhibit. And if it's all successful, then there's a whole lump sum of money that comes through, and there may be less in the way of expenses because all of that happened last year. So the ups and downs are very real. And so if this business is generating a loss in any given year, and it's part of what we do, and you're going to come in over the top and say, well, that's not deductible, you know, that's got a financial consequence for us, you know, at least in timing. So they basically had a carve out of those rules and said, look, the rules still exist, we're not going to just ditch them, but we are going to say to you that if we can see that your other income sources, and that's everything, that's part-time work, it might be government benefits, it might be a full-time position, you might hold shares or an investment property, or basically anything outside of your writing. All of that income combined from those other sources, if that's 40 grand, well, if that is under 40,000, then we'll take that loss from your arts practice and we'll allow you to just write it off. So it's a break. We personally think that they should ditch that 40,000 because it's a completely arbitrary type of measure, but the threshold is 40,000. And so we've got clients that, you know, will sometimes even be under or over that 40,000 threshold. They might have a part-time job which is flexible somewhat in those hours. We've got some clients that take part-time work and deliberately try to structure that part-time work to stay under 40,000 so that they can know in the back of their mind for their tax planning all the year round, is like, well, look, I know that all of my other income is underneath that threshold, and so long as it is, then if my writing does produce a loss in this year or next year or just dotted years, then the rules will allow me to just simply deduct that loss against my income from other sources. In terms of like trying to know where on earth you stand each year with your tax, that's something that you're trying to find out from the outset. Where on earth am I going to stand this year so that I don't just get the unexpected tax bill? But there can become a point where that full-time employment or part-time employment or part-time leading to full-time, everyone's in different boats. If it starts to get more and more over a 40,000 threshold, there's only so much you can do to deliberately curb your income. It's kind of counterintuitive. So everyone in that boat actually has to reach a point where they say, well, now I'm in a little bit of a different camp where I am earning more than 40,000 from my other sources, and so that particular threshold is sort of knocking me into a different sphere with these non-commercial loss rules. And so what does that mean if you're over 40,000? What it means in brief is that the non-commercial loss rules do apply. which means if you've got your art practice, your writing practice, and it has generated a loss in this particular income year, the question is, have I reached any of the other tests, the non-commercial loss tests, which you might actually satisfy, which will then allow you to deduct the loss. Now, these are also pretty arbitrary tests, but there's basically 4 of them. 2 of them are relevant and 2 of them are not so much. So one of them says, if you can show that you've generated $20,000 gross income, so forget about expenses, this is everything before expenses. If you've got $20,000 gross, at least, so 20,000 is the threshold, 20,000 or more. If it so happens that you've had one of those years where you earned 25,000, but you still spent 30, and so you've still made a loss, they will still allow you to deduct the loss because, again, in the ATO's infinite wisdom, $20,000 is some sort of mark as to whether or not the business is, successful. But that is a threshold. So that can sometimes be a threshold for people to also be knowing in the background to understand what their overall tax planning for the year is looking like. Has my gross income ticked over 20,000 yet? Because if it has, and I'm still generating a loss because of all the expenses, I know that I will at least get an immediate deduction for that loss and everything will net out. But if it's not over 20 grand, then what's going to happen to you is they will quarantine that loss. Now, what that might mean physically for you, or financially for you, is different in every case. The main thing that we find with clients is not so much the presence of a tax bill, but just the knowledge that it's coming and being able to plan for it. But you do need to recognise that if you haven't reached that particular 20,000 mark, that loss is going to be there. It's still real, and the tax office ruling still says that you're in business and the loss is there, and it's got to be recorded on the tax return. It's just that it's going to sit and be quarantined, and it needs to be carried forward into your next year until such time that the whole merry-go-round goes around again, and maybe you can reach one of those different characteristics, one of the tests. So if you haven't reached 20,000, there's another test which is also quite relevant for you. It's what they call the profits test. And so that will look at your business and say, okay, you've made a loss this year, but what's the performance of that practice been over the last 5? If we can see that there's been a profit made in 3 out of the last 5 years, including this current one, then we'll also allow that loss to be deducted now and net everything off. So again, that's where all of the artistic practices sort of lobbied in the very beginning to say, look, we've got these up and down trends that happen in our practices. Sometimes we do make a profit, but that's no guarantee that it's going to always be a consistent profit. So sometimes we've got clients that if they come to us and the business is pretty much broken even, we'll look at them and say, well, look, let's say that the profit was $1,000. It's like, and yes, like any profit's a good profit, but what we would say is like, you know what if we were to take away some of the expenses? And let's say, if they've made a loss, but only a slight loss, then we would say, why don't we look at what the business is like if we just take some of those expenses out and put your business into profit? Now, we're not going to put it into a big profit, but we are going to put it into a profit. Because if we can put it into a profit this year, maybe there's a little bit of a tax impost that comes from that, but it's probably not going to be that much. But in the context of trying to generate profits in 3 out of 5 years, you've just generated a year where there's been profit. So that's not always possible. It's generally only on borderline cases that we would take those expenses out, but it's also something where you can be planning around these non-commercial loss tests. The other 2 tests are not really that relevant. They basically talk about a business having $100,000 worth of business assets or $500,000 worth of business real estate. And those 2 are more aimed at the farmers, where they're generating losses from their land, but they've got lots and lots of combine harvesters and very expensive pieces of equipment, or particular like homes on farming land. So that's not so much for you, but those are the other two tests. So pretty much the 20,000 assessable income test and the profits test are the ones that you need to be mindful of in understanding how all of your income outside of your writing and the performance of your writing practice are coming into play with each tax return. Specifically earlier, there was actually another question raised with me, which I thought I'd share, because sometimes it might be that people have got eligibility for certain family payments and sort of like government pensions, which may not be actually technically accessible. And so for those people, you know, they're also managing, you know, other income streams which may not even find their way onto the tax return to begin with. So for those people, maybe their true 40,000 is lying somewhere else. But that's the sort of thing that you need to break down specifically with an advisor, or go down a very specific rabbit hole with the ATO yourselves.
Is that 40,000, does that have to be a hard limit before expenses are taken? So if I earn 42,000 but I have $3,000 worth of expenses, can I still do it at 42, or do I have to come up to 40?
It'll be the 42.
42.
Yeah.
Okay, so that's still okay, because that will drop me below the 40.
No. So if you've got other income sources, let's say it's a common example would be a part-time or full-time position, and you might still have some basic work-related expenses that you claim against that salary. So the salary might be 42,000, but then you've got $3,000 worth of expenses, which bring what would otherwise be a taxable income down to 39,000. You would still be caught by the $40,000 rule, because the 40,000 test, because it's what they call an assessable income test outside of your art practice. So what they're looking at is not the final taxable income from all of your other sources. They're looking at all of the gross income that you've generated. Gross dividends, gross income from rental properties, just gross. What can I claim? Oh, now he's finally talking about something that matters. Okay. Honestly, the real big rule here is that you can claim almost anything. The best part about you people in the room is that you are creative, and this is where you can be most creative. Everyone's laughing, but it's actually true. The actual deduction provision in the Tax Act, Section 8.1, it basically says you can deduct from assessable income any loss or outgoing to the extent that it's incurred in gaining or producing that income, or, and this is the key part of it, it's necessarily incurred in carrying on a business for the purpose of gaining that assessable income. So the first limb of that provision is talking about a really specific, what they call nexus. You know, if you've earned an amount of income and you've got an expense which you can absolutely relate to it specifically, then that part of the Tax Act says, well, it's going to be pretty much claimable then, unless there's an exclusion in the Act which specifically excludes it, and there's always exceptions to rules. But it's Part B of the definition which is most relevant for you. Necessarily incurred in carrying on a business for the purpose of gaining or producing assessable income. That is a lot more broad in its terminology, and throughout all the ages, that's the way all the court decisions have been handed down. So what's necessarily incurred? It doesn't mean that the ATO's got an ability to come at you and analyse your expenses and say, you spent this much on Facebook ads for the last year. We think that's a bit excessive. So we're going to put your claim down to maybe just half of the Facebook ads. They've got no right to come in and do that. So long as you can show a nexus between the expense and the way you conduct yourself in business, you are going to be satisfying that provision. A big example which helps to illustrate that point is that mobile phone. We all use our mobile phones, and unless you're actually one of those rare cases that is operating more than one phone, then the vast majority of us have one mobile and it's used for both business and private purposes. So that expense right there is both a business and a private expense. Necessarily incurred in carrying on a business. Is your phone being used, at least in part, for the purpose of carrying on your business? Yes, it is. And so that part of the provision says it's deductible. Now, it's only deductible to the extent that it's being used for business. And so the lovely topic of substantiation and record keeping and logbooks and travel diaries comes into play. But that's what you need. The concept of being able to link a particular expense with your activity and get a deduction for it is just absolutely intertwined with substantiation in the Tax Act and being able to prove to that ATO auditor ultimately that that nexus exists. There's no nice way of being able to get around that proof. The proof is on you. The Tax Act is one of those lovely areas of law where the system is guilty until proven innocent. But we know, we've got about 1,000 clients on our books, and I've worked in the practice for 20 years. In that time, I've seen probably between 5 and 10 audits. That's a really low percentage. I mean, it's probably a nice reflection on the fact that we're doing things correctly and we're not putting up red flags to the tax office to trawl through our practice. But I can tell you in the instances where those audits happen, they are brutal. And they will look at everything that's in that return and they'll say, okay, mobile phone, this is what you've claimed. We want to see the bills and we want to see how you came up with that percentage of 50% or 60%. I know in practice for a lot of you it's just, that's a question from the accountant where it would just be, what is the business percentage? 50. It's just like, all right. But the point is, that's fine. And the risk that you're ever going to need to prove that 50 in an audit is pretty low. But if it ever happens, you'd want to hope that you'd be able to produce a whole bunch of paperwork with itemised billing or some record that you've made as to how you arrived at 50% and that 50% was actually the right percentage. So for us, we really have to be guided by what you do. We have to take at face value what you tell us. But we also need to let you know that what you're really trying to do is also protect yourself, because the last thing you want is an audit that goes pear-shaped. It's not pleasant. It's not pleasant for you. They will strike out a bunch of deductions and they will figure out the amount of tax that you should have paid, and they won't just ask for that. They'll penalise you. They'll put some sort of recklessness or culpability component on top. If all of that's come through an agent, it probably looks even worse. So what's the next step that they're going to do if they've had a good audit result for one of your tax years? They're going to go back on you as far as they're committed to do. And for a lot of business owners, that's a 4-year period. So the first thing an audit in 1 year is probably going to produce is audits for 3 other ones as well. If they're going to find that same pattern, then it's about what culminates after that. So it can be a bad experience if they don't go well. So that's why accountants, if they ever bang on about substantiation, it's very true. Cars, very, very, in particular with logbook periods, we probably don't need to go through all the specifics today, but there is an entire section of the Act which talks about what a car logbook actually is as far as the tax office is concerned. It's not just about scribbling down some kind of kilometres. It's actually a very detailed log that's got to have a whole requisite set of information before it's valid. And if it's not valid, then you just can't use it at all. And so all the record keeping that you've done throughout the year, being so diligent to keep all of your receipts and all of your repair and maintenance bills and keep the car loan statements and find out how much interest is being charged on that loan and do all the right things, can all just come unstuck at the last hurdle because of one little technicality in the logbook which isn't being kept correctly. So these are the little intricacies which do exist. Record keeping is very boring. But I can say that the more that you get into a really good habit every day of thinking about these things, that's when the record keeping will end up being a lot easier. If you're trying to compile one whole year of your life once each year, it's always painful. If you've got systems in place and you're thinking about these things all the time, and you're getting logs together, and you've got the mobile, every time that mobile phone bill comes in, even if it's just putting it aside so that it can be collated later, at least you've got it. So there's only so much accountants can do for you if all of that documentation is not there. There's a lot more that we can do when the documentation is there. But more than anything, it's about saving your own bacon if and when that tax office order that comes. I will just address one little thing, because this was actually one of the specific questions which came at me. What do I do with assets? Can I deduct them? What if I have to write off books? What if I purchase my own books? What if I lose stock? These sorts of specific questions on where do I sit with being able to claim these sorts of things. Under small business measures, which have been in place for quite a few years now, probably most of you in the room would realise that we're in a very generous time frame with the ATO, where any sort of assets that you buy, so long as they're under $30,000, each and every one of them, you are in a position where you can deduct that all up front. So it used to be what they call depreciation, and having to depreciate these things over time. But now I think we're mostly in an era now where even if you're sensible enough, you can even buy a car. And so long as that car is underneath $30,000, and you take all of those extra steps to maintain logbooks so that you can demonstrate to the ATO how much that car is being used for business, you could be getting very sizable tax deductions for the entire purchase of a vehicle. And we see exactly these things occur in our practice. So we've been going through a period recently where that particular 30,000 threshold has been changing quite a bit. It really only used to be about $1,000, and then it got increased to 6.5, then it went up to 20, it went up to 25 very briefly, and then from 2nd of April 2019 it went up to 30, and that's where it is at the moment. You'll often hear, because I know that you all tune into budget night like I do, that particular index, that threshold is something in the Act which needs to be continually revised. So the government is now in this position where it's very hard to wind back once they've given it to us, but they are having to make a statement each budget as to whether or not that threshold is going to be extended for another 12 months, lifted or brought back. At the moment, it seems to be at the 30,000 level. Yes?
Matthew, for us, blocks of ISBNs an asset or an expense?
Yeah, so that's an interesting one. So when you've got a concept of basically a stock of books, right? When you've got that, again, under small business measures, normally there would be what we call this trading stock rule, where you need to, when the income for each of the book sales is coming through, the actual cost has come from somewhere. Like there's a body of costs which create all that, and so there's a concept that against the income, what can we write off? We can write off the proportional cost that, how many was sold, 1, 5, 50, whatever it was. And the body of costs which can be taken up to say what is the cost of the stock could be a bunch of different things. So you do have this underlying concept of needing to be aware of where all of that stock is, but you could probably, that can be a bit of a minefield. That can be tricky. So what we find in the creative space is that the small business rules have got a whole series of different little provisions, and they look at little things like depreciation. One of them is trading stock. So one of the things that we rely on is that under the what they call simplified trading stock rules, you do need to have an idea of what your trading stock at the end of a financial year is. But if you can be satisfied that the movement in that value from year end compared with the year beginning is less than $5,000 worth in changes, then the ATO say to you, we don't expect you to do an actual stock take. So what that means is that well, number one, you don't have to do the actual stock take, but you don't have to be necessarily accounting for those particular values. Okay, so what that means is, in practice, is that all of the income, that's still income, and that's going to be reportable. But the real question is, what's the body of costs underneath all of that? So if you've added a whole bunch of extra like costs or purchases to that stock value over the year, the first step is saying that is actually prima facie tax deductible. So it's building the increased costs of your stock. But what happens at the end with the stock take is they say, okay, well, that's okay. First step is that it is prima facie deductible, but then we come in at the end of the year and look at the actual level of stock that's still there compared with the beginning, because there's a mathematical formula that goes on to sort of take stock, for want of a better word, of what's there at the start, what have you added to it, and then what's there at the end. And we're only going to really allow a tax deduction for the amount of all of the expenses that are still traceable back to the amount of income and the amount of stock that's being sold. But if you've got a rule that's coming at that equation from the closing stock side of it, it's almost like algebra, where you're trying to solve for a particular element in the equation, and they basically say, look, you've still got the same starting point, you've added all of the extra costs throughout the year, which are prima facie deductible, and then we get this closing stock figure at the end of the year, but that's actually the same figure. Well, we've determined that the change in it is actually not that much from the beginning. So we've got opening and closing readings, which are the same as our previous year. What that ends up doing mathematically is essentially giving you a tax deduction for the primary costs that you've had in that year. We've got 1 minute. In that case, we are grossly out of time. Income averaging. Home office, come and talk to me about home office. Income averaging, probably come and talk to me about income averaging. It's actually quite a specific little provision. Has anyone in the room heard of it? Most of the room are underneath that particular provision. All right, well that's great. We don't have to. Foreign withholding taxes. Yeah, all right. So look, this is a little bit of a minefield as well. But basically I would definitely, anyone that's got particular questions, come and pick my brains throughout the day. There's no easy set answer for foreign withholding taxes. It's about finding out what you can from the various sources of information you've got. So as accountants, we find that information from a whole bunch of sources. Sometimes it's WAPNs, sometimes it's Form 1042Ss if we're talking United States. Sometimes it's printouts from the publishers which are telling you how much income is coming through and how much withholding tax is part of those sales. The main thing that the accountants need to know is the amount of those sales and whether any foreign withholding taxes are embedded in it. It's really just a disclosure thing in the tax return where the ATO says, we want to know about your foreign income, but we also want to know about the amount of foreign withholding taxes that are embedded in it. Because in practice, or as a basic top line statement, whatever tax you're subjected to here in Australia on that income, and you are, what the ATO is also wanting to know is like, yes, but if you've already been taxed on that income at source overseas in different jurisdictions, then we'll give you a credit for those foreign withholding taxes that you've already paid so that you're not, in effect, having to pay tax on that income twice. Now, it goes into more depth than that, and that's probably where it's one-on-ones throughout the rest of the day. The other stuff that really is following on from that, GST and the business structures, there's probably less on that material, to be honest. So, yeah.
There you you go. Part-time hitman, full-time accountant, Matt. Say hi, hit him up during lunch or afterwards, and with specific questions, and hopefully they'll be able to steer you in the right direction to maximum profitability, which is what we're looking for. Thank you very much. Next is lunch. We'll tell off-color jokes while you're eating for no reason whatsoever except to fill the void, or we just hang out and talk. All right, you guys have a good one, and next session will be, yes, 1:15, I believe. We have Mal Cooper, so I'm going to try to link her in while we're eating lunch and make sure it works, and then figure out how I can show her you guys. Thank you.